Thank you for joining us at XM.com. An extremely busy week lies ahead of us. It holds two central bank meetings and crucial data for the United States and the Eurozone. So let's get right to it. I'm Christina Marujos. With me today is our lead investment analyst, Rafi Boyadjian. Rafi, the main event of the upcoming week, without a doubt, will be the first Fed meeting for 2024. No change in policy is expected at this meeting, but investors still expect the first rate cut to come in March. Do you think Powell will justify those expectations?
Well, Christina, as you quite rightly said there seems to be a bit of a gap between where the Fed sees rates ending the year and where the markets see rates ending the year. We've had a bit of paring back, of course, recently in terms of, a lot of investors paring back their, dovish expectations. Nevertheless, there is still a bit of a gap there, and we're going to have to wait and see whether Powell will attempt to steer markets more towards the Fed's thinking. I think the thing we probably need to be cautious about is that Powell does tend to strike a balanced tone, so we're probably not going to get an overly hawkish view from Powell in this press conference. And also, it's hard to see anything much changing in the statement, although we may get some hints that FOMC members have started to discuss the timing of a rate cut. The question now is how soon that first rate cut is going to come. Expectations for March have kind of dissipated lately, so the market thinking is more towards late spring or early summer. Will Powell try to completely rule out a March rate cut? Will he keep the door open to an early rate cut? And also not just March, but the first half of the year, as a whole, whether he's going to really push back and say we don't expect any rate cuts until the second half, because of course inflation is falling in the US, so that's why the markets are kind of insisting that the Fed will, that they're right and the Fed will actually respond to the drop in inflation.
Let's stay in the United States for a while longer. Non-farm payrolls is out on Friday, that report. What are we likely to see in the numbers and how might the dollar move?
Well, yeah, so the NFP report for January is going to come days after the Fed meeting. So in fact, it may be that which sets the tone for the US dollar. Now, of course, last time we had an upside surprise. Are we going to get another one this time? Overall, though, it does appear that the US labor market is heading towards a soft landing, which effectively means a soft landing for the whole US economy. Should we get another upside surprise, I think we would have to see a very big beat in the headline payrolls numbers to kind of change the narrative as far as the outlook for US growth and US inflation is concerned. And even if we get us an upside surprise, if Powell, strikes a balanced tone and the other data, of course, it's going to be pretty busy in terms of other US data releases. We've got the ISM, for example, coming up as well. Then it's hard to see any reaction to the NFP data being knee-jerk. And so probably, I think we're probably going to have to wait and see a little bit longer to see how the inflation jobs data evolve as we head towards the March meeting.
Let's cross into the United Kingdom now. The Bank of England meets on Thursday. Again, no change in policy is anticipated, but inflation across the region remains uncomfortably high, Rafi. So what might policymakers signal at this meeting regarding potential future rate cuts?
So the Bank of England has seen quite a dramatic fall in UK inflation, but it's still one of the highest in the advanced economies. It did edge up ever so slightly to 4% in December. Now it should continue to come down later in the year, but I think the main concern is that core inflation in UK is quite elevated at around 5%. So I don't think the Bank of England is going to sort of do too much now in terms of sort of exciting the markets by signaling a rate cut. However, we probably will see some kind of a dovish tilt by the BoE because, of course, until the last meeting, we still had 3 MPC members voting for a rate hike. We may see that dissent disappearing now. Maybe those 3 officials will decide to vote for no change for once. It's also possible that maybe 1 MPC member will vote for a cut. That would be quite a dovish signal. Also, the Bank of England may tone down, its rhetoric about keeping interest rates higher for longer or keeping rates in restrictive territory for a prolonged period of time. So we might see some tweaks in the language as well. So overall, there's a risk that the meeting will be negative for sterling. But at the end of the day, that dynamic between pound dollar and pound euro, the fact that Bank of England will probably be the last to cut interest rates, that's unlikely the meeting will unlikely change that. So in the bigger picture, this meeting will probably not be the decisive one.
And finally, Rafi, let's turn to the Eurozone. It will be a crucial week for the single currency as we'll get GDP data for Q4 on Tuesday, followed by CPI numbers on Thursday. What could we see in the data and how might the euro perform?
Well, Christian, the data might in fact be more crucial for the euro than the ECB meeting was, because we kind of knew what we were going to get from the ECB meeting, but the data will be quite important because the GDP numbers will probably confirm that the Eurozone economy did indeed enter recession in the final 3 months of 2023. And also in terms of the flash CPI estimates for January, we may see the headline figure further climbing, possibly to 3.1% in January. So how markets would react to this is going to be a little bit tricky because we kind of already know in terms of the economic landscape, and probably investors will see the uptick in inflation as a temporary one. So overall, the euro will probably remain on the back foot against the US dollar because, of course, investors have a strong conviction that the ECB will soon begin cutting rates, possibly late spring or at the June meeting. The problem is, of course, if we get a downside surprise in the CPI numbers, that could really kind of put more pressure on the euro because the ECB would have little reason to wait before cutting rates.
Rafi, thanks so much. This was The Week Ahead here at XM.com.